The obvious way to get a lower monthly payment with a mortgage is to put a larger down payment. However, there are some other ways that you can utilize to get a lower monthly payment. Today, I want to show you 6 different ways that may help you in the strategy to get a lower monthly payment. Because with a lower monthly payment, that may mean you can qualify for more. My name's Miles Pitcher. I'm the owner of Superior Lending here in Utah. I'm a loan officer. Our first strategy is discount points or buying down the rate. Most of the time when you talk to a loan officer, they may not present this option to you, but you should ask it. You should say, hey, what does it cost for me to buy down my rate? Depending on the loan product, the lender, that buy down can be a couple $100s to thousands of dollars to buy down your rate. The way we measure it, and the thing you need to look at, is how much does it cost to step down an eighth in rate, and how much does that save you in monthly payment? We divide those out and see how many months it takes for you to break even. And then we look and say, hey, is it a 3-year break even? That makes sense because you're going to be in this home for 10, 15, 20, 30 years. But if it takes 15 years for a break even, that really doesn't make any sense. You can evaluate it, but as you look at discount points, always look at what the break even is. Mortgage insurance, private mortgage insurance. This is a big deal. I first want to say that on FHA, there is a standard mortgage insurance rate. So this really won't apply for FHA loans. VA loans don't have a mortgage insurance on them. USDA loans have a fixed amount. So we're really talking conventional loans only here. There are many, many options on how to deal with private mortgage insurance. And I will tell you right now, there are options. There are many companies that provide them, and they are not all the same rate. So it is something that your lender should be shopping for to get you the lowest mortgage insurance rate. Mortgage insurance is determined by 2 things: how much down payment you put down and where your credit score is at, and sometimes also how many borrowers are on the loan and your zip code. Some get zip code specific. All these factors contribute in getting your mortgage insurance rate. Now, there are options where you can buy out the mortgage insurance, and sometimes that can save you quite a bit. It's something that should be explored. I'm not going to take a deep dive into PMI right now, but there is opportunity there to be able to reduce that down or eliminate it, especially if you have a high credit score. You should be rewarded with a very low PMI rate. Number 3 is accessory unit apartments. So these are mother-in-law apartments. There is one conventional loan product that allows you to count rents towards qualifying. That's a conventional product. Talk to your loan officer about that. However, even if you don't need those rents to qualify, you can still qualify and buy the property. These are great to look at to be able to collect some rents to help offset that mortgage payment. More and more cities are starting to allow these. You may look at a home where you can have the opportunity to put an accessory unit in and then rent it out. This is one of the ways that cities are dealing with some of the housing issues, is to become more lenient in these accessory units. Generally speaking, they will require you to owner occupy one of the units in the property. They will not allow you to move out and rent both units. Number 4 is to look at bumping your credit score. There are different thresholds in pricing and rates on credit scores. For example, if your credit score is a 679 and we can bump you up over a 680, you're going to get a benefit in mortgage insurance. You're going to get a benefit in your interest rate. And there are different thresholds with different lenders, but generally 740 is the highest. So anything above that is all going to be the same. Sometimes they give you a benefit at 760 or higher. But there are oftentimes simple things that can be done, such as reducing credit card balances. Doing things like that to help your credit score quickly pop up. We have some credit tools for simple credit repair that can help boost scores, and we love sharing those with our clients. If you have some serious things on your credit, we often refer those out to legitimate credit repair companies. If you ever need to know the name of one, let me know. I have some good ones that we work with, and we've had great results with them. But just doing a few things to get your credit score up can make a huge difference in getting a better rate, getting lower PMI, therefore reducing your monthly mortgage payment. One of the main questions that needs to be asked of every client is, how long are you going to own this home or live in it? If it's going to be 10 years or less, you really need to look at the adjustable rate mortgages. Right now, they are pricing really, really well, low rates compared to the conventional rates. An adjustable rate mortgage means that you have a fixed rate for a period of time. Like, let's say we're doing a 10-year ARM or adjustable rate mortgage. The rate's going to be fixed at 10 years. And then after the 10 years, the next 20 years will be at an adjustable rate, and it will adjust based on an index that it's tied to. Most of them are getting tied to an index called SOFR, SOFR, Standard Overnight Finance Rate. But these are incredible products that you need to be aware of. They scare a lot of people, but if you know that you're moving out of that home or refinancing in a short period of time, these are great options to look at. If you're looking at doing new construction and you're fearful of rates moving up while you're in construction, you need to talk with your lender about getting a long-term lock put in place. For us, we're doing those 60 to 120, even up to 180-day locks so that our clients are protected if rates rise during the construction period. The other option to this is doing a one-time close, which I have in a different video that you can check out. But doing this will protect you in a rising rate environment so that when you get done with the construction, you have certificate of occupancy and you're putting in your long-term financing, you're going to get a great rate. Let me give you an update on where rates are. This is a big deal. So these are as of, and that says March 16th. It's actually March 17th, 2022. The Federal Reserve met yesterday and they raised rates 25 basis points. Not mortgage rates, the federal funds rate. This is the rate at which banks borrow from the Federal Reserve, not mortgage rates. They raised it 25 basis points, which was expected. The market was hoping for more than that, but they watch closely what the comments are from the Federal Reserve chairman. And he talked about that they are expecting, and the members of the board are looking at 7 additional hikes in 2022. Why are they doing this? They are doing it to get inflation under control. And as I'll remind you guys every time, inflation is the enemy of mortgage rates. So as inflation is taking off, our mortgage rates are being hurt. You can see this chart, how it has steadily gone down, which means rates have steadily been going up. Now, the big thing that we listen for is what we call the balance sheet runoff. For quite a few years, the Federal Reserve has been buying mortgage-backed securities. These are the bundles of mortgages that are being sold, and they have bought them and held on to them. They have stopped buying those mortgages, and now they're starting to get rid of those. They did not provide a lot of detail when they're going to start unloading those, and there's 2 ways that they can do that. They can either start selling them off, or as people are refinancing or selling their homes and paying off mortgages, it just gets paid off and it comes off their balance sheet. The balance sheet runoff, in short, is not a good thing for mortgage rates. So that we're watching very closely. They said it's going to happen in the future. They did not indicate a date when. The bond market is expecting that to be in the May meeting when they start doing. All in all, though, I want you to be aware that mortgage rates are awesome right now. They are still really good if you look at them in the big picture. My name is Miles Pitcher. Always happy to help you guys with any questions you have. I hope you have a great week. We'll be back next week with another tip.